So welcome, friends and family. This video will be the first of a 4 or 5-part series on giving you some ideas on how to structure a portfolio. We'll have two basic tenets to it. The first and foremost is probably preservation of capital. So designing a portfolio that will protect you in bear markets. And the second objective is to provide you at least an average or better than average return when bull market conditions exist. Just a disclaimer, obviously I've gone through this before. I am not a financial advisor. I'm not licensed. These videos are simply for educational and entertainment purposes. They're my ideas. Take them with a grain of salt. So that's my disclaimer. If you're an investor, you have an investment portfolio, and you're quite content with a return of 2, 3, 4% a year, you don't mind if the market or your portfolio has a 20 to 50% drawdown because the market always comes back, then you can turn this off. I mean, this video and the ones that follow are not going to benefit you at all. But if you're not in that camp, carry on. So reviewing the agenda for this series, the first will cover asset allocation, a discussion of equities versus bonds and what's the appropriate allocation. I have some strong viewpoints on this, which are probably not consistent with most financial advisors, but we'll go into that in more detail. The second will be mutual funds. What are the advantages and disadvantages? There are some really good ones. How do I find those good ones? And when do I use mutual funds in my portfolio? The third will be talking about exchange traded funds, ETFs. What are they? How good are they? How expensive, and so on and so forth. And the last part of the series will be creating your own fund with a basket of stocks rather. What are the advantages, disadvantages, what's the optimum number, and so on. So today's video will deal with the first one, asset allocation, equities versus bonds. Now, I don't have a financial advisor. Some of you do. If you Google it nowadays, financial advisors, equity split between bonds or portfolio split between bonds and equities, there's generally a 60-40 rule. In other words, you should have 60% of your portfolio in riskier assets such as stocks or equities and 40% in bonds. I would argue that's complete crap. In most instances, in my opinion, there are bonds should be non-existent in your portfolio, other than at times, perhaps times that we're in right now, where you possibly could get a better return from bonds than you could with cash. But the question to ask is never equities versus bonds. To me, it's bonds versus cash. What's the argument that the advisors use for bonds? Generally speaking, there would be two. One is it provides a stable source of income. And the second is it provides a safety net in the event that equities go down, bonds generally don't go down. And so your portfolio as a whole has some sort of insurance or protection. My argument against both of those points is that a stable source of income doesn't really matter. What matters to me is that my portfolio value is going up, and I shouldn't care whether that up is a result of interest I'm getting on bonds or dividends from stocks. Or an increase in stock value. Up is up. So the fact that advisors are counting on a stable source of income, to me, it doesn't seem relevant. The second point is equities, bonds provide a safety net for equities. That's true. And we've got some charts here I'll show you that is true when equities go down. But this presupposes that you never sell your equities. And this is the point that when I Google and do some reading on this, the buy and hold in mentality takes over. And so certainly at times the equity component goes down 30%, and you don't sell, you're still holding. Bonds arguably will be better. But if you had a very simple, keep harping on this 8% sell rule, or if your longer term, the price goes below the 40-week moving average, you're out and you're in cash. You never experience these massive big drawdowns that the bonds are intended to protect you in the first place. So that's my logic for that. And I'm going to show you probably some real life examples here. Load up. So this out of the way. So this is the Vanguard Total Bond Market. This is a bond fund. And let's go actually change this to a comparison chart. It shows up better. So again, this chart goes back a year. So it goes back to September 17th, 2021, starts at 100. And today's value is 84, 85-ish. There's an index scale here, and it basically uses as a comparative chart to see how your one or two or three instruments or stocks or indexes or whatever compare to each other. So here's the performance of bonds in the past 12 months. That's not pretty, but let's compare it to the Standard & Poor's 500. So the equity, if you had an equity component, it's not pretty either. Actually slightly better, but for all intents and purposes, both bonds and S&P 500, the equities, are down about 15% year to date. So if you had your advisor had given you the traditional mix of 60% equities, 40% bonds, they're both down 15%. If you had been 100% equities, 100% bonds, or 100% equities and 0% bonds, you'd still be down about 15%. And vice versa, if you were 100% bonds, you'd be down 15%. Although the bonds probably would have given you about 2%, 2.5% of interest throughout that period of time, but that's not nearly enough to make up for the difference. So in times like this, neither of these are a good place to be, but clearly debunks the theory that when the market goes down, bonds don't, and you're protected. But this is only 1 year. But who knows when this bear market's going to end, but we're a year into it. But let's go back 3 years. Let's just rewind the video to 2019 and see. Okay, they both started at 100, and your equity part of your portfolio, despite this massive big drop here, has come back, and you're now at about 130, 30% higher. Bonds, of course, basically, we're still down about 85, down about 15%. And you would have got your interest for 3 years. Let's say you average 3, 4. I don't know what interest rates were on bonds for the last 3 years. Can't imagine they were more than 3%. So he picked up $3,000 a year on $1 million portfolio. So, you know, that's 9%. You're still not back up to even. Where bonds did outperform was this period here, when this is the COVID crash. Let's get this out of the way again. The COVID crash. And clearly in this period of time here, from March 2020 to September-ish, August, September of 2020, bonds did outperform. But as I've been harping on ad nauseum, had you had some sell rules in place, you'd have been out somewhere up around here. You'd be in cash. And so the argument would have been, do I hold my cash or do I put it in bonds? But the rest of the time, bonds have severely outperformed. And if we put this in more real terms, I'm going to go back to 2021. Let's say I retired in September of 2021. I had $1 million investment portfolio that I'm relying on to provide me some income. And let's say I needed to withdraw out of that retirement fund, or whatever you want to call it, $100,000 a year. That was my requirement that I needed over and above what other income I had, because I don't have a job, don't have any other investment income, a little bit of Canada pension, and so on and so forth. You get the idea. So you can make up your own numbers, but for my assumption, I need $100,000 a year. Well, my $1 million that I started with, whether I put it in bond funds, equity funds, or a combination of both, either way, I'm down to about $850,000 in value. And I've had to withdraw for 12 months, 100 grand. So really I'm down to 750 and no prospect of this going back up in the near term. So this is worrisome. If you're in this situation or about to be in this situation, it's time to start thinking about selling the house, or I don't know how you can cut your expenses back, but it's not a pretty situation. So let's go back. Say I retired 3 years ago. Oops. And let's assume again, same scenario, had $1 million to start off with. And that's, I'll use two extremes. One is I put it all in equities, none in bonds. Well, and let's presume further, I don't have any sell rules. I had no idea what those were at the time. So I allowed this to happen. Now I'm 100% in equities. Well, today, at least I have $1.3 million in value. Where it would be less than that, because over the 3 years, I've withdrawn $300,000, $100,000 per year. So really, I'm just back to where I started. Cause for concern, but not panic. Although this past 12 months would have panicked me a little bit. Had I been in bonds, 100% bonds, and let's say no equities, well, my million is now down to 850 and change. I've withdrawn 300. I'm down to 550. I'm running out of money. Like I'm hooped next year or the year after. Then so you could take the math a little bit further. Let's say I had 60% in equities and 40% in bonds, which is the traditional split that advisors would have you in. So I've got, I can't do the math in my head that quick, but you've gained 130, but only 60% of your portfolio's there. So that's 60, 30, 780,000. And my 40% of my bonds, they've gone down by 15%. So that's 60,000. So I can't do the math in my head that fast, but clearly I got less than $1 million. And I've had to withdraw 300. So really I'm down to about 800,000-ish, somewhere in here. Terrible outcome and a terrible video, which I'm going to stop.